In the shadow of giants like Nvidia and AMD, there exists a layer of the semiconductor industry that is less glamorous but fundamentally essential. It is the layer of power management. Every device, from your smartphone to your electric vehicle, needs to manage electricity efficiently. And one of the most interesting yet volatile players in this space is Alpha and Omega Semiconductor, ticker symbol OSL. Today, we are going to tell the story of AOSL. We have analyzed their financial journey from the peak of the 2021 boom, through the painful inventory correction of 2023 and 2024, and finally, to the emerging signals found in their latest Q1 2026 quarterly report. This is a story of a company trying to break free from the cyclical chains of the PC market and reinvent itself as a premium power player. Let's rewind to the fiscal years 2021 and 2022. This was the golden era. The world was working from home, and demand for PCs and gaming consoles was insatiable. AOSL was firing on all cylinders. In fiscal 2022, their revenue peaked at over $777 million. Their gross margins, a key measure of profitability, expanded to nearly 37%. The stock price followed suit, hitting all-time highs. It seemed like the supercycle would never end. But in the semiconductor world, every boom is followed by a bust. As we analyze the 2023 and 2024 annual reports, the picture changes dramatically. The post-pandemic hangover hit hard. The PC market collapsed. Smartphones slowed down, and AOSL, which was heavily exposed to these consumer sectors, felt the pain immediately. By fiscal year 2024, revenue had contracted significantly to $657 million. But the real damage was in profitability. Operating income, which stood at $133 million in 2022, evaporated to just $9 million in 2024. The inventory correction was brutal. Customers stopped ordering new chips and spent a year working through the piles of chips they had panic bought during the shortage. This brings us to the present moment. We have the fiscal year 2025 annual report and, most importantly, the fresh Q1 2026 report, covering the period ending September 30th, 2025. What is the data telling us? The data suggests that the worst is behind us, but the recovery is gradual. In the first quarter of fiscal 2026, AOSL reported revenue of $181.9 million. This represents a modest year-over-year growth of roughly 1.1% compared to the same quarter last year. It's not an explosion, but it is stability. More importantly, let's look at the gross margin. In the depths of the downturn, margins were under severe pressure due to underutilized factories. In Q1 2026, the GAAP gross margin came in at 28.6%. While this is still far from their peak of 37%, it shows that pricing is stabilizing. The company is no longer bleeding margin just to move product. But the real story for investors lies in the strategic pivot. For years, AOSL was known as a PC component company. If PC sales went down, AOSL stock went down. Management has been fighting to change this narrative. They are shifting their focus to Tier 1 customers in automotive, industrial, and smartphones. In the 2025 and 2026 filings, we see evidence of this shift. They are highlighting wins in solar inverters, electric vehicles, and premium smartphones. Why does this matter? Because these products have longer life cycles and stickier relationships. Once you are designed into a car, you are there for 5 to 7 years. It creates a floor for revenue. Let's talk about their technology. AOSL isn't just a commodity supplier, they possess sophisticated packaging technology and proprietary silicon platforms. Their new IGBTs and silicon carbide solutions are targeting the high-power market. However, R&D expenses remain high as they invest in these new technologies. In Q1 2026, they spent over $18 million on R&D. They are betting that these investments will pay off in higher margins down the road. Financial health is critical during a turnaround. Looking at the balance sheet as of September 30th, 2025, the company holds approximately $166 million in cash and cash equivalents. Their total debt is manageable. This gives them the runway to navigate the current macroeconomic uncertainty without the risk of immediate insolvency. However, we must address the risks. The elephant in the room is geopolitics. AOSL has significant manufacturing operations in China through its joint venture in Chongqing. In a world of trade wars and tariffs, this supply chain exposure is a risk factor that appears in every 1OK they file. Investors must be comfortable with this geographic footprint. Also, the recovery in the broader semiconductor market has been uneven. While AI chips are booming, traditional analog and power chips are recovering more slowly. AOSL is not an AI play. It is a play on the broader electrification of the economy. So, what is the verdict? Alpha and Omega Semiconductor is a classic cyclical recovery play. The bust of 2023 to 2024 has reset the baseline. The company has survived the downturn, maintained its R&D, and is slowly pivoting toward higher quality revenue streams. The stock is currently priced for skepticism. The market is waiting to see if they can get their gross margins back above 30%. If the global economy achieves a soft landing and consumer demand picks up in 2026, combined with their new automotive wins, AOSL has significant operating leverage. This means a small increase in revenue could lead to a large increase in profit. The cycle is turning. It is slow, it is grinding, but the direction is upward. For the patient investor who understands the power of cycles, Alpha and Omega offers a compelling risk-reward proposition in the semiconductor mid-cap space.